Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 20th. Chinese stocks cratered on Monday, but bounced back today after the government announced that GDP rose 7.4% last year, beating estimates by a bit. It's remarkable that the authorities were almost able to hit their 7.5% GDP target while continuing reform measures. Nonetheless, it's clear that the momentum of growth is slowing, and with producer prices strongly in deflationary territory, the deflationary impulse emanating from China is not likely to abate anytime soon. So, while Chinese stocks may be recovering, China's impact on global monetary policy is likely to continue to be negative. We're still likely to see the currency wars caused by domestic monetary policy spill over into the international arena this year. The Swiss National Bank's surprise ending to the Euro-Swiss floor last week has put pressure on the Danish krone, which is pegged in a band relative to the euro. Denmark yesterday cut its interest rates 15 basis points to defend the peg. Could its peg be in danger too? It's possible, but less likely than Switzerland. First off, the Danish krone peg has been in place for over 30 years, compared to less than 4 years for the Euro-Swiss peg. Secondly, Denmark hasn't seen the kind of inflows that Switzerland has, and the Danish central bank's balance sheet hasn't ballooned like the Swiss National Bank's has. So, while I'd expect the krone to come under further upward pressure, I don't expect them to abandon their peg, which the economy minister said was secure. I admit, though, I didn't expect the Swiss National Bank to abandon its peg either. Overall, the dollar was generally higher this morning in Europe, gaining against all the G10 currencies except for a modest decline against the euro. The Swiss franc was the weakest of the G10 currencies as the market continues to struggle to find an equilibrium level for the Swiss currency now. At this morning's Euro-Swiss level of 1.018, it's around the bottom of the 1.01 to 1.18 range that one academic paper last October said would be the Euro-Swiss franc range derived from options contracts if the pair were trading freely. So perhaps it's now back to the minimum of what the market had thought to be fair value for the pair. I expect Euro-Swiss to rise somewhat further towards the middle of the range, which would be around 1.095. For today, the German ZEW survey for January is expected to rise for the third consecutive month, but this may not be enough to reverse the negative sentiment towards the euro. The pressure on the common currency has intensified after the SNB's unexpected move last Thursday, which fed speculation that the ECB must be preparing something gigantic. In the U.S., the only indicator we get is the National Association of Home Building Housing Market Index for January, which is expected to show a small improvement. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.